Hi, KT family. Today we will be talking about tackling students' loans. So, right now in the status quo, Americans are facing an increasing cost for higher education. If you look at these graphs carefully from NCAS and Statista, Americans owe $1.75 trillion in student debt, and this continues to increase every year. In fact, average annual charges per student for higher education in public and private institutions in the United States has grown to nearly over $30,000. This is continuing to increase and is especially high for private institutions. Please take this into consideration when applying for colleges, and it's really important to address when applying for student loans. While we recommend seeking alternative ways to fund your education, such as scholarships and aid, many Americans ultimately need to take student loans to fund higher education. Now ask yourself some of these following key questions to decipher which path works best for you. So first, we have federal loans. 1. Fill out the FAFSA and complete the loan counseling and sign the master promissory note in order to understand what you qualify for. Private loans, which require a credit check and a cosigner who can guarantee to pay the loan back if you can't pay it back. And then there are institutional loans. So these requirements depend on the college that is providing the loan. This is not super common, so please take this into consideration when choosing a path. Now, how much can you borrow? Consider the borrowing limits for each type of loan. Federal direct loans have limits based on your year in college, dependency status, and college costs. Private lenders place a cap based on income and credit check. Considering your total college costs, you may need to think about different loan options, but always maximize your federal direct subsidized and unsubsidized loans first. Now, what is the interest rate? Your interest rate is extremely important. It means how much more will you have to pay from what you borrow. So because you have borrowed money from an institution, a bank, from the government, you do need to pay it back with additional costs for the sake of borrowing it initially for a long period of time. So the lower interest you have, the better option there is. So for instance, if you have a 4% interest, you only have to pay back 4% of what you borrowed rather than something that, let's say, you have an 8% interest rate. Most loans will begin to accrue interest as soon as you take out the loan, except federal direct subsidized loans, which are updated annually. So you have to continuously report your income, any changes in financial status, stuff like that. Now, what are your repayment options? Usually, student loan repayment is delayed until you're no longer a student, but your repayment plan after graduation will depend on loan type. So first, you have federal direct loans can often adjust your repayment plan based on your income. Your profession might also qualify you for federal loan forgiveness programs. So this is for especially students that are going into a field that might not serve super high salaries. They will consider that as well. Private loans are usually less flexible when it comes to repayment, which is why we recommend students to first max out their federal loans as much as possible and then look at private loan options. So what are exactly federal direct loans? There are a few pathways when it comes to the federal direct loans. So for students, loans are given directly to the student if you choose that pathway, or your parents can decide to take on that loan, and that can be taken out by typically any parent or guardian that the college children desires. So if you're a student, you typically go for the Stafford loan, and this can be subsidized or unsubsidized, and then parents typically have just a basic plus loan. So how do we break down the subsidized and the unsubsidized loans for Stafford? So for subsidized, 1, no payments until after you graduate. 2, interest rates around 5.5%. 3, government pays interest while in school. 4, students with a financial hardship typically go for this option. And 5, most go to the student whose family's annual income are below $50,000. Now, for unsubsidized Stafford loans, you are responsible for paying off all the interest. So interest builds up at a fixed rate of 5.5% while in school. Payments are typically deferred or postponed until after graduation, and all students are eligible for this loan. As for plus loans, It's created specifically for parents that are helping fund their child's education. So parents take out a PLUS loan based on their good credit history and based on the children's maximum college tuition minus any aid they received. The current interest rate for a Parent Plus loan is 8.05%, which is fixed for the entire duration of the loan. You'll be expected to make payment when the loan is disbursed unless you requested a deferment until your child graduates from college. As for private loans, so here's a few key information regarding private loans. When federal aid and family contributions combined won't cover everything, you may need to take out private loans to fill the gap. 1. Compare private loans from multiple lenders, including banks, credit unions, and online platforms. 2. Consider factors such as fees, interest rates, and length of repayment, along with options to pause payments if you run into financial trouble. Most private student loan borrowers will need to apply with co-signer because they lack credit. Where can you find private loan options? So websites like collegefinance.com provide great options for private loan information and interest rates. Some common choices also include College Avenue Student Loans and Sallie Mae, which have low interest rates and flexible prepayment options. So here is an example of a private lender information. This is with Sallie Mae. So your fixed APR is about 4.5% to 15.49%. Your minimum credit score should be around mid 600s. Multiple repayment options, including no payment in school. So there's a lot of flexibility. And international students and DACA students are eligible to apply with a U.S. citizen cosigner. So here are just some key points. Maximize your federal direct student loans before considering private loans. 2. Unsubsidized loans are the most flexible and offer greater security for low-income students. And always seek debt-free alternatives such as scholarships. Even if you think you might not receive them, it's great to apply, and even if you do get them, that allows to subsidize some of the costs in the long term. I hope this was helpful. Thank you so much.